So thanks everybody for coming. I know it's the last event. I actually did one of these at a FinTech week. I was on the last panel of the third day, and of all the different talks that they had, I had to do regulation on the last one. I think there were 3 people there, and half the people falling asleep. So this is pretty impressive that this many people showed up for regulation at the end of the day. So as David said, our talk today is covering on MiFID II. And we have an interesting panel today because we have both some of at Capitec we do regular reporting. We have a couple of our competitors and a couple of different arms that we work with. So I think it's going to be a really good kind of wide spectrum of the market, kind of like cover different types of clients and issues. Please apologize for me playing on my phone. It's actually my questions over here, so I'm not dozing off myself. Okay, so before we get started, I wonder if everybody can just give a quick introduction of who you are and what you do, starting with Andreas.
Thank you, and thank you for the kind invite. My name is Andreas Roussos. I am a partner at Point 9, a direct competitor of Ron. We specialize in EMIR, MiFIR, ASIC, and FinFact reporting. Happy to answer any questions you guys may have. Again, thanks for hosting me.
Yeah, we're all friends, which is pretty good about it.
Yes, we are.
Hi, I'm Quinn. I'm the co-CEO of Traction FinTech and one of the founders. We also do regulatory reporting. So we do EMIR, MiFIR, and ASIC, OTC derivative reporting. And we're a friendly competitor of Capitec too. Thanks for inviting me along.
Chris, I work for UNX, a Pan-European exchange. We sit quite often between the regulators and both clients directly for their regulatory reporting, as well as working with a range of providers, some of whom are around here today. We represent a diverse mix, I guess, of Pan-European clients, from very small outfits with less than 1 report a day, right up to those with several million.
And the last one, Len Delicat from Market Access Tracks, everybody. We run an MTF and an ARM and an APA and SFTR and a bunch of different regulations. And like Chris's firm, we sit between firms and the regulators. I spend a lot of my time speaking to the regulators. We're connected to about 16 of them across Europe. And so hopefully I'll pass on some of what they're thinking to you, give you some of their insights today.
Thanks. All right, so we're going to start with mistakes. In the past month at Capitec, we've had a few firms that had to do a rerun of almost 2 years of their regulatory reporting because they found a glitch in the pricing of how their OMS systems are sending us data, and that had to be changed. I'm curious to hear what on your end, what are you finding that your clients have had errors and had to be making fixes? Start with Len.
Thanks, Ron. Do you know what? Everything has been wrong since MiFID. I mean, there's no firm that has maybe not had an issue. If you think about it, everyone was so concerned in the second half of 2017 about getting ready that things might have been done quite quickly, and there's probably been issues with every field. But I think the key thing is that the firms, recognize themselves as fast as they can. The kind of glib thing I say is, if the regulator is doing your quality assurance on your trades, the game's up by then. What they want to have is firms proactively finding things, back reporting them, and telling the regulator about it. So, I mean, there's problems with everything, but I think it's how you approach that and fix it up that's quite key.
Yeah, I think we've seen over the last probably 6 months more and more firms coming to us and saying, we found an error, speak to a regulator says you've got to start back at January the 3rd, and it's costing them a lot of time in terms of their operations to correct it. Even if there's no public sanction, I think the cost internally to go back and correct all of that is probably heavy enough as a sort of a fine, as it were. I think it's the simple things which are often caught. So are you using the right timestamp? Is it UTC time? Is it the major or the minor currency, GBX, GBP? You know what, there's a lot of technical checks which can be caught along the chain, but there's also business things which you might not catch. And generally, regulators are understanding. If you are open with them when you find them and have a plan to correct. I think the key is that you do that and try and catch them sooner rather than later.
Yeah, it's a tricky one. There's been quite a few problems, but I think the core one and the most fundamental is it reportable? So with EMEA, it was pretty well subscribed. It's OTC derivatives and exchange-traded derivatives. With MiFID II and MiFIR, there's this concept of traded on a trading venue and underlying traded on a trading venue and components of a basket. So a lot of the tricky stuff and indices, CFDs on overseas shares, it can get quite tricky to find all the different trading venues and find out whether a product is actually reportable or not. And clients really think it should be simple. It's rules-based, is it reportable or is it not? There is a FCA system which is supposed to help sort that out. It's crap.
So what do you advise to people when they're looking for an option from 3 months ago? And
yeah, look, use your best efforts. I mean, we'll look it up for our clients. We have a process. It has a manual component. We look it up on Reuters. But things change. FCA's had a flush out. There are certain products that had mistakenly been added to the FCA's database. That's the technical system, but it doesn't overwrite the regulation. And sometimes you have conflicting things. So something by law is reportable, but it hasn't been added to FCA's. So the system doesn't work for it to get accepted. I suppose the second thing, especially for FX and CFD providers, is the quality of data around the client. So coming into MiFID II, everyone was getting ready. A lot of people thought, well, it's similar to EMEA. Why do we have to report to both? They didn't have a lot of quality around digital information around their client. A lot of the onboarding information had been used just to onboard the client, do the KYC, and then put in a drawer. And so having quality formatted names, dates of births, and national ID numbers was very difficult. And explaining to clients that there's 28 plus different rules there instead of one.
I think just to complement what you're saying about what do you do, what can you be doing, what I've found when we're speaking to firms is the people who sit in a room and try and work out transaction reporting by themselves have struggled the most. If you sit there with 4 different documents, one of which is the ESMA document, which is 250, 400 pages long, I can't remember. If you do that, you're going to go around in circles. Speak to your peers, speak to any providers you use. If there's any industry associations, speak to them as well, because your peers will face the same problems. And it's not a competitive issue, and therefore there should be forums that you can go to get that support. Regulators, I think, tend to encourage it because it just leads to better reporting and better compliance.
Andreas?
I'll take us all back to MiFID I times. That was supposed to be simple reporting, just a few fields, one-sided. And even until last year, we saw huge fines to huge financial institutions. Was it because they really didn't know how to report? Was it because they wouldn't go to an arm to do it? Or because nobody really pays that much attention because it's not a profit-making task in a company? They don't really see a value in it. Fast forward, we had the introduction of EMIR, which was the really first and big transaction reporting regime in Europe. Day one, no validations, nobody was ready. Trade repositories, market participants, regulators. 2019, still we see a lot of problem in the data that is reported. In the meantime, we had MiFIR, SFTR is coming. So, and at the same time, we see fines for MiFID I from FCA a year ago. So, I see a lot of participants just treating transaction reporting as an, okay, yeah, we need someone to do it. I'll call Ron, Quinn, Len, Chris, Andreas. Let's get over with. Time flies. We see a lot of mistakes. Yes, we've had customers in terms of banks, hedge funds, FX retail brokers that now, all of a sudden, they were pushed from either internal audit or the regulator to look into their data, and all of a sudden, they pick their own mistakes. So it's a market that nobody's being proactive. The regulator knows that, so they give you an option to modify a trade or a position, to cancel, still no fines. And I think we have not seen all the problems, apart from the retail FX sector, because SFTR will not affect them, but I think that in the rest of the industry, within the next 18 to 24 months, we'll come up with all the mistakes. And I am skeptical, but we come to the point where we say, okay, whatever you reported thus far is wrong, let's delete it and start from the get-go.
So, Andreas, you brought up a good point about just the data quality, and you're saying with EMIR, how no one's really done anything, there haven't been any fines there. I'm curious to hear from Len and Chris in terms of, you guys are actually receiving this data that we're all sending to you and then sharing it with the NCAs. We know that in terms of EMIR, they have had questions about EMIR quality. They have questions about data quality. Obviously, they haven't found anyone, but in terms of MiFID, are the NCAs being more proactive and having questions about it?
Oh, God, yes. Okay, so if there's one thing I can leave you guys with today, do what Chris said. Get a little SWAT team internally to look at your data and make sure it's okay. But the other thing is follow the trail that the regulator's leaving. In this case, I'm going to talk about the FCA. So what have they dropped so far? They had, in the middle of 2018, they had an open forum, and they talked about all these issues. Those slides are public and on the internet. Please look at those. And then two things, Market Watch. So if you Google FCA Market Watch 59 and FCA Market Watch 62, it's all in there. And I'll tie this back to all the fines under MiFID I. What really regulators don't like is, hey guys, I've told you about this very publicly. I've let this breadcrumb trail of all these issues. If you don't crack those ones, oof, anything could happen to you at that point. Seriously, I don't want to scare you, but that's kind of, they really dislike that. So yes, they're catching a lot, Ron, and they're telling us about it. So it really behooves those who care about data quality to follow that trail and to make use of that information and have a little fire alarm internally to make sure you don't have those same issues.
Are they saying back to you guys, go alert this to your clients that are having these problems?
Oh, so us, no, yeah, with the ARM, no, they regulate. We're regulated, and we face fines if we do something wrong. But no, it's always the end firm. Sorry, good point.
Yeah,
it's always the end firm.
With the trade repositories, there seem to be more of the data in terms of EMIR, where they're actually saying, you guys are doing this. You guys are collecting, should be telling your people that are reporting it to you to do it a little bit better. So you're not getting that feedback.
I don't think so. It does depend on the regulator. I think the FCA likes here's a big public document with all of the information that we would expect you as compliance officers to be aware of as senior managers in that business. There are some other regulators who we hear very infrequently from, to be honest, but there are some who they're checking everything already from you sent us as a trading venue this number of transactions from this firm, we've only got this number via the client for their transaction reporting. So they're starting to do cross-checks of different data sources. Different regulators are at different paces. I think the thing is as well, they're not catching all the issues because there's a number of issues in there that are business related and they may not catch. The issue is going to come. It's there for investigation as much as anything, this transaction reporting. If they go and they need to get some data and you then go, oh yeah, sorry, it wasn't right, we didn't give it to you properly or there were errors in it, that's when there will be serious repercussions, I would suggest. So I think it's about, yes, they are catching mistakes. Don't rely on, oh, the FCA haven't come to me and knocked on my door yet to mean we're fine. What it means is that there could be an error there, and they probably, if they ever do find it and you haven't told them, that's, I think, where they'll have more serious discussions with you. I think if you find an error and you come back and say, hey, we found this, I'm sorry, we're going to correct it over this time frame, I don't think that's what any of that's where the tough conversations are, unless it's systemic. I think it's more where they need data for an investigation, and it's not there, and it's not accurate.
So Chris, you mentioned a few times that you really want to find these mistakes before the regulator does. In terms of just, I want to hear feedback from you guys. What type of tools are out there that you could be looking? Obviously you can be manually checking your own things, but in terms of third-party things to be able to review what you are doing.
I think the first thing, just to follow up on my previous point, don't mark your own homework is always what I say in these circumstances. If you've got an IT or compliance team who are building a platform to deliver your transaction reporting, don't get the same guys to mark it and tell you that it's correct, because they're going to come back and tell you that it is, and they're probably not catching the mistakes that they should have. Also, don't rely on a subset of your data. I think the firms who, there's a number of service providers out there who might just say, okay, we'll take a subset, 5 transactions a month. If they're fine, it's okay. I think you need to realize that you can't point to a third party to take responsibility in case of an audit from a regulator as to what processes you have got. But at the same time, if you can point to a third party who has probably got better systems and processes that you can build internally, that's a good way of doing it, I would suggest.
That's good advice. And kind of what, now that we're 22 months or so, 28 months into MiFID, we looked at our database and realized we have 2.5 billion trades in there. So we're building a back testing tool that every day so we see, X million trades a day coming into the arm every day. We're running all sorts of algorithms and machine learning across that data backwards, so that if Ron's firm has been trading like this, and all of a sudden he goes off the curve, by gross notional or value or something like that, we can kind of highlight that to Ron. So I think that's part of the not marking your own homework is, find a partner who can help you with peer analysis, because you can get yourself right to your own data standards. But if you're off the market and not with the herd, then yeah, you might have a surprise.
Well, if I may add to that, we all talk about what we do. At the end of the day, it's all about data, reliable data. Trade reporting is on T+1 basis. So, the brokers, you may have a risk system that you need data live to make decisions. What we need to report, all of us here, is T+1. So there is a time to correct the data, to validate, send to the regulations, and there can be mistakes that we cannot pick up and the regulators cannot pick up, and they will be found upon when someone does a thorough investigation. I need to see your database and then what is reported to Trax or CME or whatever. So we may do all the validations in the world, but we are as good as the data we take from our customers. So we've had a couple of customers that was obviously a glitch in their system, so they've got 2 traders that were 192 years old. Okay, yes, we picked it up once, right? Outliers, like kind of what you do, so we put the system in place. But that does not mean that none of us can think of all that can go wrong and pick it up. So it's all about data. Brokers, you know your data best. You just need to give more emphasis on giving to your suppliers and then to the regulators the correct data.
I think ultimately it comes down to how seriously the broker takes it, because they're going to have to allocate money and resources to it. And it doesn't really give them any added benefit generally, except for avoiding trouble with the regulator. So it depends on the client. I mean, some will engage quite expensive third parties to come and perform those audits and reconciliations. And look, quite frankly, others won't look at it. They'll assume they've sent it off to you, it's done. And yeah, so there's a range, and that people will end up at the other end when there's more fines. And market watches are great. 59 especially, people start to take that seriously. There's similar things coming out of SISEC at the moment, which is a good start. But really, it's about consequences. When they see one of their peers, a similar firm, get slapped for something, they'll go, oh, we're doing that, we're making that mistake. And unfortunately, it'll take that for the whole market to move to that quality of reconciliation.
I think there's one tip. If you're a UK investment firm and you haven't logged on yourself to the FCA system and downloaded some data to do your own audit, you're on a blacklist somewhere, because they've very publicly said, we expect investment firms to log onto the FCA's portal, download the data that we have, don't rely on your arm and the reports that they send you to check against. You need to come to us and check that what you send into your provider is what we're meeting. If you haven't done that, how easy is that for the FCA to see which investment firms have logged on and which haven't? So I think that's a starting point, certainly.
To add just a small note to that, I'm sorry. Buffin went out to a few of our customers about MiFIR reporting, right? And they said, what you report does not match exactly 100% of what your counterparties report, right? MiFIR, not EMIR. So that shows you, the regulators, how seriously they are taking that. Matching in MiFIR.
Just to add on what Chris mentioned about the reconciliation from the UK investment fund. So if you have to do a remediation with the FCA, on their form it actually asks who's in charge of doing the reconciliation. So if you say no one, then that's another problem.
That's a problem.
Yeah. Okay. So kind of, I want to stay on the idea of the brokers, and specifically to Quinn and Andreas. You mentioned a little bit about just CISEC doing a little bit. So one of the things that CISEC has done recently is that they sent a circular all about problems with best execution, include both monitoring and RTS 27 and 28. They were a little ambiguous, saying that these are problems and some people are doing it right, some people are not. Andreas, I'm just curious, your understanding, you think people are doing this correctly, or is it a problem, is it a systematic problem in the market where there's violations all over the place?
It's a market problem in general when it comes to any kind of reporting, like prudential, trade, transaction reporting. Anytime CISEC, for example, if they send you an email saying there's something wrong, you ask them a question. It may take them a month or 2 months to answer. Problem is that there is not enough peer-to-peer discussions. Like there's no associations to help out all the, from the smallest broker to the biggest bank on what to do. European regulations are not exact. It's not 1 + 1 makes 2. It can be 2, 1.5, 2.5, 3, 4. So there is a lot of lack of knowledge. The regulator is not actually being in a position to advise the customers. So for the time being, the best execution reporting is anybody's guess. It reminds me of the beginning of EMIR 2014, that everybody was just sending a file. Let's put a file into SFTP and let's pray to whichever God we believe that it all will be good. So there's huge problems for the time being.
Quinn?
Yeah, it's first of all, the regulation doesn't really look like it was designed for a lot of the client base that's here today. It's really about venues, and then it was extended to liquidity providers and market makers, and clarified in a Q&A that would apply to FX and CFD brokers. But the fields are just not relevant to someone who's running a MetaTrader, whether they're on a full dealing on own account license or a reception and transmission. Neither RTS 27 or 28 really fit those requirements, right? But they've been made to do it, and I think that's just, ESMA, when they went to Q&As, they're okay, let's be hard on the FX and CFD industry, not easier on them. Let's not let them off the hook. And best execution isn't prescriptive enough, right? So people don't really want a trade report, but if you really, as a regulator, if you're clear what they have to do, like market watchers, you have to do this, you have to do it by T+1, you have to fill in these fields. Best execution is very, very vague, right? So when brokers are torn between so many different demands, they come to you and say, exactly what do I have to do? And it's so vague. So you've got vague regulation, and it wasn't really written for this industry and its models. And then, CISEC, again, in a difficult situation because they're enforcing something that they didn't write, that doesn't make sense on an industry who doesn't know what it means. Sorry, but that's
a recipe for disaster, isn't it?
It's not the best place to start, no.
I want to just have one final question before we give it over to questions. So, Chris and Len, one thing I hear about, and I've probably heard this 5 or 6 times today, they're like, why do we even have to do this? The regulators don't care. They're not even looking at it. So I guess the question is what do they actually look at when it comes to the MiFIR data?
I mean, they look at it all the time. I mean, that's the thing. So,
but obviously you can look at it, but are they gaining anything out of it?
Oh, yes. Oh, they're gaining a couple things. So they're always looking to bust someone for insider trade. Do you guys know what they do with transaction reporting data? Do you want to hear in 20 seconds? Okay. So say drug company A is buying drug company B. They know who is advising them from insider lists on who are the corporate finance guys. So all that goes, so they have all those lists. And any ISIN to do with ARB, any bond, equity, swap, anything, they do systematic looks at those ISINs on certain dates when there was publicly available information or not to see who was doing what. They look for Chris or Ron if he's dodgy, but they're not. building up slowly a big position. The PA, right before the PI comes out, they dump it, or that kind of thing. So that's what they're looking at. And there's just some of the nuggets from meeting the regulators is a lot of them do price testing already on equities and bonds because they think they're good quality. So they take a price out of Bloomberg or Reuters and put that across, and that's way beyond what the ESMA validations are. And to your point, Ron, they use it, they go, I'm going to use it for market abuse, but half the time when they find data quality issues, is they think they see something that looks like market abuse, but guess what, it's a data quality issue. So they don't even have to look for data quality issues, they find it just doing their day job, which is market abuse monitoring.
Chris, you have more to add on that?
Detection and investigation, really. So it's what can they use detection? In reality, they're only going to get more sophisticated on that. If you think about the quantity of data they're dealing with today, it's huge, but they will invest and they will improve their effectiveness. I think that's why they get annoyed at data quality issues, because that is a huge cost on them achieving their aim and they're meeting their responsibilities, because they keep bumping into these issues which look like they're problems, and any false positive or whatever you want to call it, that's where they really get, that's what really costs them time and money to investigate, and that's where I think they see challenges. So if they are using it for better, to improve markets. Their sophistication in doing that, I assume it's a little bit clumsy today. It's only going to improve tenfold over the next couple of years.
Okay. Any questions? No?
What do you think the biggest challenge is versus when it first went live? So I know you've spoken about some specific field examples, but more holistically, what do you think the biggest challenge is for TR?
I think firms are still learning, and I think they haven't. The expectation from regulators is that firms have now learned their lessons, and they're expecting firms to have done that. But because of other business priorities, I don't think firms have done that particularly well, to be honest. And I think the tolerance from regulators is reducing, and our firm's really still as committed to fixing those last couple of gaps as they would have been a year ago. Possibly not when other things have got in the way. So I think the thing that need to be conscious of is expectations are rising from regulators, and you might not be seeing the fines. That doesn't mean there's not more and more email and written communication between regulators and investment firms, because their expectations are higher.
Thank you.
Can I add a couple quickly?
Very quickly.
Very quickly. Okay, so two things. I think it's 80-20. The easy flow monster stuff the firms have right. It's the stuff that's more tricky from a technical perspective. I'd check that. That's on the input side. And then the other thing is the output side, controls. So even today a firm said, you know what, when we were rushing in 2017 to get everything in, what's the first thing you cut in your program? The controls. Because you just want to get that, as someone said, you just want to get that data to the regulator. Guess what? Now you got to look at it again. So I think your control environment is the other one now.
All right, thank you to Andreas, Quinn, Chris, and Len for your comments, and everybody for coming here. Just two takeaways. So first of all, have do the spot checks, have someone else kind of like review your data in order that the regulators don't find out what you're doing wrong. And also make sure you kind of look at what the FCA's what the FCA and the regulators are kind of hinting to the market that they want you to be watching. So thanks a lot again. Thanks for attending, and enjoy the rest of the panel. If you're looking if you guys want to go to the party and you didn't register, we have a couple extra tickets that we can give away. So just come out to me.
Thank you.